Well, yeah, I mean, I think certainly inflation in the U.S. is likely to prove more sticky in our mind compared to other developed markets, Europe specifically, partly because of the resilience of the economy that we've seen. But you know, there's going to be some normalization going forward. Remember that some of the inflationary pressures were driven by supply side constraints from the pandemic, which have been easing. And also, generally speaking, you are seeing a normalization in the labor market with some of the excess vacancies being reabsorbed as the labor market normalizes. And so normalization means core PCE inflation, which is what the Fed focuses on, moving you know, to the 2.5% to 3% area. It's obviously still not a target, but it's moving in the right direction. That last mile, however, to get to 2%
Nicola,
could be a bit hard.
I think really the underlying question here is, when are you expecting a rate cut, especially after that really red-hot retail sales number? We have Jay Powell speaking later today, before that industrial numbers in the U.S. So it's becoming harder and harder to predict. But right now, where do you stand? When does that first U.S. rate cut come?
Yeah, look, it's becoming more uncertain given the resilience of the economy and some signs that the last mile of inflation is hard. But at the moment, we still expect a couple of rate cuts this year, probably starting, you know, not long after mid-year. So that's still our expectation, but there's no doubt that, you know, risks are rising, that the Fed will have to wait longer.
I want to take your thoughts on the bond market, the differences between the U.S. and Europe at this stage, given the different rhetorics and the expected different speeds, really, from the central banks in both parts of the Atlantic. We are seeing European yields rising, but a lot less compared to what's happening in the treasuries. Tell us what's the outlook for this part of the market when you hear that the ECB is likely to cut in June, but then the Fed probably only later this year.
Yeah, look, one big theme we've been focusing on is the divergence between the U.S. and the rest of the developed markets. You know, we see the U.S. economy as being more resilient, potentially on a more sustained basis, on a few considerations: more fiscal fuel in the tank from the checks that were handed out during the pandemic, partly, you know, lesser competition from China compared to Europe. You have AI and technology and the big investments that were made there that will support the economy. And you have a U.S. election that in most cases will probably deliver something which is positive for U.S. growth versus others. So given that, I think we have more confidence on the cutting cycle starting soon and being deeper in Europe compared to the U.S. So in the case of the ECB that we were talking about before, we see the first cut in June, and we see about 3 rate cuts for this year. In the case of the Bank of England, probably a similar picture. And I think when it comes to bonds, where we have quite a decent amount of conviction, is that the bonds in the economies which are more interest rate sensitive, like the UK, Australia, and Canada, will be those where we can see performance here, with these economies having cutting cycles which are deeper than the Fed, but the market at the moment is not pricing that. It's pricing a fairly similar picture for these economies in the US, and we think there's an opportunity there.